What is an 83B election when it comes to stock options? First, let's review what are stock options. Well, generally, a stock option is simply a contractual right to purchase stock in a company. The price at which you can exercise your rights, that is, purchase stock in the company, is known as the strike price. I sell you an option, or I grant you an option to purchase stock in my company for $10 a share. If the stock later goes to $20 a share, you still have the contractual right to purchase the stock for $10. So that is a lot of value to you. The contractual right, the stock option, is worth $10. Now, that is commonly used in startup ventures. Rather than granting specifically shares to an employee, the employee is granted options pursuant to their compensation package that they can either exercise or not at some point in the future. Now, in my scenario, I grant you a stock option to purchase shares in my company at $10. I will always grant the option at the current market value of my stock. If I grant it for $9, that means it's worth $1 to you, and that is compensation as soon as I grant it to you. But if I grant it at $10, the current market value, there's no tax because now there's no value. There's no value until the value of the stock goes up to $20, and then you exercise your option and you've gained $10. So you would pay taxes at that point in time when you exercise the option. Now, there's a tricky scenario that comes in when stock options are made subject to what is known as vesting. Oftentimes, employees will not become owner of the stock option. They will not become owner of that contractual right until some period of time in the future. That is, the employee must continue to serve for 12 months, 24 months, 36 months, and the stock options granted will vest sometimes in increments, sometimes all at one time during that stated period of time. Now, this vesting has several functions, but the primary function is to keep the employee motivated and loyal to the company. The issue, though, comes about with taxes. Subsection 83A says that when a stock option vests in someone, that is, when you finally become owner of that stock option, okay, the value of that underlying stock at that time makes the determination as to whether there is tax liability. So I grant you a stock option that vests over 12 months. The current price is $10 and the strike price on the option is $10. 1 year from now, the stock is worth $20, and that's when you actually vest in the option. Subsection 83A of the Internal Revenue Code says when that stock vests, when you have ownership of it, that is actually when you incur the obligation. So at that point in time, I'm giving you a stock option that is worth $10, so you would be subject to income tax of $10 at that time. Now, if you use subsection 83B, the 83B election, you can actually, for tax purposes, elect to recognize that you have received stock options at the time of granting, even if those stock options don't vest until some period of time in the future. This is a huge benefit. You're able to recognize this for tax purposes rather than wait until later when the stock could have gone up in value, because now the stock is worth $10, the strike price is $10. It doesn't have any value. If I recognize it now, I don't pay any taxes. So 1 year from now when it vests and the stock is worth $20, it's not taxed. Not at that point in time. Because, like I say, you've already recognized your receipt of the stock option. You will not recognize that $10 gain unless you exercise the option. You actually pay the $10 and get stock for $20. At that point, you would recognize the option for tax purposes. Okay, so that's the important part of IRC 83B. Employees who receive stock options that are subject to vesting must make the election within a relatively short period of time after receiving the stock option to recognize the value of the stock option immediately, which should be zero value as long as the strike price is equal to the current market value. So in the future, you can defer recognition of that income until you actually exercise the stock option at some point in the future. That is, you actually pay the strike price and purchase the stock at the strike price. So that is how the 83B election works in conjunction with the grant and vesting of stock options.